The European Union and our four friends from Mercosur, Argentina, Brazil, Paraguay and Uruguay, have just reached an agreement. This is a historical moment. These negotiations have been 2 decades in the making, and the fact is that today, exactly today, 20 years ago, they were launched the 28th of June 1999 in Rio de Janeiro.
Today's Council decision marks a historic day. Europe is sending a strong signal. We are serious about our priorities, and this landmark deal will create growth, opportunities, and greater prosperity for European citizens and businesses. We are creating the largest free trade zone in the world. That's a market of 700 million people. And Europe is starting a new era of cooperation with our partners in Latin America and beyond. I will soon travel to Paraguay to sign the agreement.
I want to move on to the Mercosur deal, which is one of the most important things here, because we talk about things, atrocities that are happening around the world. European Union is committing an atrocity here. They're bringing in beef from a country that we cannot trace. Minister, you know as well as I do that this is the best beef in the world that we're producing here in this country, that there's 100% traceability. So why would we want to move away from that? Why would we want to have carcinogenic beef coming into this country or coming into other European countries at any time? That's poisoning our own citizens.
Thank you, Deputy.
Europe just handed itself a new trade weapon, and its own farmers are the first to feel it. After 25 years of negotiations, the EU has moved to lock in the EU-Mercosur trade deal, and the backlash is already loud. Farmers across parts of Europe are warning that this agreement will flood the market with cheaper South American imports, push down prices, and reward producers they say don't play by the same cost, climate, and regulatory rules. But here's the part most headlines won't spell out clearly. The EU isn't just signing a trade deal. It's building a strategic escape route, away from dependence on the United States, away from being boxed in by tariff pressure, and away from a world where Europe's economic security depends on the mood swings of other powers. This isn't just a trade agreement, it's a geopolitical maneuver, a supply chain rewiring plan, a bet on the next industrial cycle. And like every major shift in global trade, it comes with winners, losers, and entire communities caught in the crossfire. Let's start with the facts the EU itself has confirmed. Under the agreement, additional preferential access for Mercosur agriculture is capped through tariff rate quotas. Up to 99,000 tons of beef, 180,000 tons of poultry, and 25,000 tons of pig meat each year. With safeguard clauses the EU says it can trigger if imports threaten serious injury to EU sectors. On paper, these quotas look manageable. The EU is huge. Spread across 27 countries, the numbers seem small. But that's not how political pain works. Markets are regional. Production belts are local. A quota that looks harmless in Brussels can devastate a specific region, a specific type of beef, a specific processing chain, especially when farmers are already squeezed by rising costs, climate shocks, debt, and supermarket pricing power. That's why the backlash is so emotional. It's not only about volume, it's about who absorbs the shock. And it's also about trust, because in the EU's internal politics, agriculture isn't just an economic sector. It's identity, land, heritage, and survival. So why is Europe pushing this now, knowing it will trigger domestic resistance? Because Europe is in a pressure vice. On one side, the United States. Tariffs are no longer a last resort. They've become a routine tool of leverage. Even allies can be threatened. Even partners can be punished. Even rules-based relationships can be weaponized when political goals change. On the other side, China. Europe buys, sells, invests, and competes with China at scale, but it also worries about supply chain vulnerability, strategic dependence, and industrial hollowing out. And then there's the wider world, critical minerals, energy transition, global shipping routes, and a growing reality that trade is no longer just trade. It's strategy. The EU-Mercosur deal is Europe's answer to that reality. It says, we need options. But beneath the speeches and the press releases is a deeper structure, the mechanics that matter more than the messaging. This agreement is a trade diversion machine. Trade diversion is what happens when a deal doesn't just create new trade, it redirects existing trade away from countries that don't get the new preferences. So while the political fight is about South American beef and poultry coming into Europe, the real economic engine is the reverse flow. Europe selling higher value industrial goods and services into Mercosur on better terms. European automakers, machinery producers, chemical firms, industrial equipment suppliers, the backbone of the EU's manufacturing base, get a bigger runway into South American markets. And that's the point. It's a strategic bet. Europe protects its industrial core by expanding external demand, even if it triggers internal agricultural pain. And that pain is real. European farmers are being asked to absorb the cost of Europe's strategic autonomy. They're being told that the future of Europe's industrial competitiveness matters more than the stability of their livelihoods. They're being told that the EU needs leverage in a world where the United States uses tariffs as threats and China uses markets as influence. They're being told that the sacrifice is necessary. But necessary for whom? Necessary for what? Necessary according to whose priorities? Because while the EU frames this as a balanced partnership, the reality is that the benefits and burdens are not evenly distributed. The winners are clear: EU industrial exporters, Mercosur agri-food giants, global shipping firms, and European policymakers who can now say in future tariff disputes, "We have alternatives." That's the deeper function of this deal. Leverage through options. The losers are just as clear: farmers in vulnerable segments, political coalitions that depend on rural support, environmental protections that may be weakened under pressure, and labor rights that risk being sidelined in the race for competitiveness. And then there's the supply chain layer, the part that rarely makes headlines but shapes the next decade. Once preferential access is locked in, firms don't just ship more. They redesign where they produce, assemble, process, warehouse, and route goods to maximize tariff advantages and meet rules of origin thresholds. That's how a signature becomes a supply chain rewiring plan. More EU industrial exports into Mercosur means more demand for components, inputs, and logistics networks feeding that export flow. More Mercosur exports into the EU means expanded cold chains, inspection regimes, processing arrangements, and port capacity. And then the strategic layer, critical minerals, and the energy transition. South America sits at the center of the global conversation around lithium, copper, nickel-related value chains, and battery inputs. Europe knows this. Even when the deal is discussed publicly as agriculture versus industry, the quiet long-term bet is access, investment frameworks, and stable economic ties in a region that will matter for the next industrial cycle. Now let's bring Canada into this, because Canada is not watching from the sidelines. Canada gets hit in two ways and benefits in at least two others. First, Canada faces tougher competition in the EU on certain agriculture and food categories. The deal creates preferential lanes for Mercosur. Even where Canada retains access, pricing pressure rises, and in quota-managed markets, space and margins can tighten. Second, Canada can lose market share in Mercosur to European exporters. In sectors where Canada competes globally, machinery, specialized industrial equipment, services, certain value-added products, the EU's preferential advantage becomes a quiet tax on Canadian competitiveness. But Canada can also win. When two big blocs tighten their economic integration, they generate new upstream demand, and Canada is an upstream powerhouse. Energy, industrial metals, critical inputs, advanced services, insurance, compliance frameworks, finance, these things ride inside every manufacturing expansion. Canada can position itself as an upstream supplier and a stable partner to European firms expanding into South America, especially where companies prefer to source from jurisdictions with strong rule of law predictability and established standards alignment. And Canada also benefits through what we can call routing value. When the trade map becomes more political, capital becomes more selective. Firms seek stable platforms for financing, holding structures, and North Atlantic market access. Canada can attract investment and corporate structuring activity when geopolitical risk rises elsewhere, not because Canada is the loudest player, but because it's the stable one. So Canada's net outcome isn't automatic, it's strategic. If Canada stays passive, it risks losing share in Mercosur and feeling more competition at home and in the EU. If Canada moves smartly, it can capture supply chain positioning and investment diversion. Now let's talk about the United States, because the US reaction is the part that matters for global trade power. From Washington's perspective, the EU-Mercosur deal is a warning light. Not because the US is excluded from South America entirely, but because Europe is building a corridor that reduces US leverage. And in this era, leverage is the real currency. So how might the US respond? Expect competitive diplomacy. The US will pressure, incentivize, and negotiate to deepen its own economic foothold in Latin America, not necessarily through one grand agreement, but through sectoral deals, investment packages, security economic linkages, and selective market access strategies. Expect defensive industrial policy to harden. More domestic support, more procurement nationalism, more standards-based barriers, and more security framing around economic policy, especially where the US sees strategic sectors at stake. Expect sharper trade enforcement posture. When preferences shift, the next fight is often circumvention. The US may intensify scrutiny on supply chains, origin claims, and import channels, particularly if it believes competitors are using trade routes to bypass US protection. And yes, there's another risk. Once the EU has a stronger alternative lane, it becomes more confident in retaliating if the US escalates tariffs. That's the metagame here. This is why farmer backlash is being absorbed. Because Europe is trading short-term political pain for long-term strategic flexibility. And then there's China, the quiet beneficiary. China doesn't need to be in the room to win. It just needs the others to disagree. The more fragmented the Western trade architecture becomes, the easier it is for China to play partners off each other. The EU-Mercosur deal deepens that fragmentation. It creates another corridor, another bloc, another set of preferences that the US is not part of. And in a world where supply chains are becoming political, exclusion is a form of weakness. So what should you watch next? Watch whether the agreement gets delayed by legal challenges and political ratification fights, because the timing of implementation matters for supply chains and investment decisions. Watch whether Europe activates or even threatens the safeguard clauses early. That will tell you how serious the political backlash is and how fragile the internal coalition remains. Watch US countermoves. New tariff threats, targeted retaliations, or accelerated US engagement in Latin America. Watch Canada's posture. Does Canada pursue deeper EU industrial alignment, expand its Latin America strategy, or remain trapped in reactive North American politics? And watch the mineral and EV supply chain moves, because agriculture is the headline, but industrial transition is the long game. Here's the bottom line. The EU-Mercosur deal is not just a trade agreement. It's Europe building an exit ramp from leverage. It's the EU saying, we won't be held hostage by any single partner's tariff mood swings. But that exit ramp runs straight through domestic political landmines, and farmers are the first to step on them. And in the background, the quiet reordering continues. Supply chains reroute, investment follows stability, and the US adjusts its strategy to keep control of the trade architecture it built. If you want the simplest way to remember this episode, it's this. Europe is paying for options. Mercosur is selling commodities for access. The US is watching leverage slip. And Canada has a choice, lose by default or position itself to win quietly in the new map. This is Liberation Lens. We report the news, and then we expose the structure underneath it. See you in the next.